Welcome everyone to our webinar around blueprints for succession planning in the construction industry. We're going to talk about general succession options, and we've got a couple of colleagues on the call here today who will talk about, not only succession routes and options, but also some of the outcomes of the October budget and what that means to construction and built environment businesses. The agenda today is to talk a little bit about sector activity and what we're seeing and what we're hearing in the construction and built environment sector. Going through a number of the tax changes from the budget, and we've got a colleagues covering that off. Before we talk about succession planning options, so we talk about a range of options, and there's opportunity for people to answer questions and ask and answer questions at the end. Now, there have been a couple of questions sent in advance, but if you do have any questions, please use the chat box on your screen to ask questions throughout, and we'll try and cover these off if we have chance. The intention is to run for just under 30 minutes with a chance to cover off questions at the end. In terms of who's on the call from TC Group, my name is Patrick Fornan and I'm the head of corporate finance here at TC Group.
Good morning, everyone. My name is Paula Carter. I'm an associate director of corporate finance at TC Group, and I work with business owners on growth strategies and also working with them on succession.
Hi, I'm Trevor Shaw. I'm a tax director with TC Group, and I work with businesses of all shapes and sizes.
Thank you all. In relation to sector activity, now I'll probably make this budget related. So, as those on the webinar here today will appreciate, the budget was pro growth. However, the impact on employers' national insurance will have a detrimental impact on those businesses or your businesses where you're employing people. The cost has gone up, and I think, Trevor, we probably could explore that in a little bit more detail today. However, the investment mantra from the government and referencing £100 million of capital expenditure, we can only feel optimistic and buoyed by what's in store, I think, for the construction sector. Although, as people on the call will acknowledge today, it's can be not without its challenges, particularly in certain pockets of construction and built environment. In relation to the transactional activity, we've actually seen an uptick in construction activity post-COVID, actually, with more and more internal solutions considered. So what I mean by internal solutions are sales to management, so management buyouts or similar transactions, and also sales to employee ownership trusts. Now, there have been a number of high-profile construction and built environment sales to EOTs, but I think in the latest statistics from the Employee Ownership Association, construction is the third highest sector of employee ownership, I think, behind professional services and manufacturing. So it's still buoyant and still a route that's popular amongst construction and built environment. This probably also aligns with our experience. So we've supported clients in trade sales, management buyouts, and employee ownership sales across architectural practices, cost consultancy firms, building contractors, and also building materials businesses. So say we've been buoyant and active across a number of sectors in the built environments. Moving on for some of the changes from the autumn budget. So over to you, Trevor.
Thank you, Patrick. Well, the big headlines that were around in the budget: capital gains tax, the much expected increase in capital gains tax rates. The good news is they weren't as high as everybody was talking about them being or expecting them to be. They weren't at the 40% or even 30% mark. Instead, it's been increased to 24% for higher rate taxpayers and 18% for basic rate taxpayers. This effectively brings it in line with the rates for selling residential property. So for landlords, then there's no real increased cost there for them, but still an increased cost that people need to take into account when they're looking at realizing the value of their assets. Moving on to business asset disposal relief, which is obviously closely related to capital gains tax. Before the budget, you could sell your business and get the first £1 million at 10%, and thereafter you were paying the main rate of capital gains tax. And they've kept that for the rest of the tax year. However, from April next year, the rate is going to increase to 14%, and then in 2026, it's going to increase to 18%. So bring it in line with the lower rate of capital gains tax. Now, for a lot of business owners who are thinking of selling their businesses, this may make them think that they would like to sell the business slightly sooner than otherwise. And I think that may well be the case, but they need to take into account what it really means to their pocket. If you can sell slightly later at a higher price but pay slightly more tax, you may be better off waiting. On the other hand, you may be better off selling earlier. So I think it needs to be looked at by every business owner in relation to their own personal circumstances.
Thanks, Trevor. And that probably aligns with what we're seeing in the corporate finance team, because a lot of clients are saying it'd be a nice to have, but if it doesn't happen, we've not got a weaker negotiating position if we are selling, and the tax change from, you know, that it could be £40,000 per individual. So it's not detrimental if the price, you know, is maintained or a greater price at a later date. So no, that's echoing what we're hearing back from our clients, which is really helpful. Thank you.
Inheritance tax, which I think is possibly one of the big nasties in the budget. The main headline for business owners isn't the fact that the nil rate band isn't going to increase until 2030. It's the loss of business property relief. Or I say the loss of business property relief, it's going to be limited to £1 million from April 26. And thereafter, it will be effectively a 20% tax rate. So somebody with a business worth £10 million passing that on death, instead of that having no tax bill to it, we'll be looking at a £1.8 million tax bill. Now, this does mean that business owners may want to revisit their existing ideas of when they were going to pass the business on to the next generation, and they may want to accelerate that forward. But that's something I would like to talk about a little bit later.
Thank you, Trevor. Now, moving on to what that means, and I suppose what the succession planning opportunities are across the built environment sector. So, Trevor, if you don't mind starting us off with some share option planning.
Yeah, so share option planning, share incentive planning, they are right and very good ideas for the right businesses. The sorts of businesses that it really benefits are those that are looking to sell the business down the line, and they want to keep key employees in the business because they know it will help them grow and develop the business. But they don't wish to give up control of the business at the same time. So one of the things that employers can do, business owners can do, is offer an employee the right to buy shares at a price agreed today in the future. So they can buy the shares maybe when the company is sold. So the EMI scheme allows you to do that, enables you to agree a price today with HMRC, say at £1 a share, and down the line, the employee can sell at, say, £10 a share. Now, for that employee, that's a £9 profit, and they could be paying tax at business asset disposal rate. Taxes at 18%, certainly a lot less than a bonus if it was paid through the salary for them, which would be at least 42% for them. That is a huge incentive for employees to stay around because they could make an awful lot of money, stops them going off to the competition. But why would the businessman want to do that? Why would he want to give up 5 or 10% of his company in this process? Well, if his business is worth 100 today, or you think it'll be worth 100 in 5 years' time when you sell it, if you incentivize those people and it's worth 120 in 5 years' time, and you only own 90% at that point rather than 100%, you're getting 108 rather than 100. So that means you get more money, the key employees get more money, and the tax man gets less money. So overall, very good for everybody. And why would the tax man want to do that? Well, if your business is making more money, you've paid more tax along the way, but also you're growing this country's economy. So beneficial to everybody.
Brilliant. Thank you, Trevor. And again, we've seen this used in certain instances, and we've seen some quite pleased employees on the way out. You know, if there's a sale event in the future, getting to that 120 that you referenced, yeah, it works for all parties involved. Moving on to kind of wider succession planning. So if you don't mind covering these off, please, Paula.
Yeah, thank you, Patrick. So when we're working with business owners and exploring succession options, these are the areas that we'll typically look at and explore with them. So first of all, let's start with trade sales. So what does this mean? So a trade sale is a trade of your trading entity or assets to a third party, to another trading entity. What we tend to see with these types of transactions is that the consideration, the valuation is higher. We see higher multiples than typically with a management buyout or with an EOT, which tends to be driven by the competitive process that we run, but also by the synergies that may be available to the parties in terms of potential synergies within finance or IT or indeed property. What we also see with this is that there's a accelerated payment to the sellers, and typically see these transactions being fully paid within 2 to 3 years as a result of buyers funding transactions from their own resources or securing acquisition finance to make the transaction, or being backed by private equity as well. However, these transactions aren't without risk. They do require a rigorous due diligence process, because the buyer, being external, needs to make sure they fully understand the different facets of a business. So for a business owner, it takes up a significant amount of time and effort in return for that enhanced valuation. And as a result of that, also there is a higher risk of higher completion risk of deals not completing due to findings that may be revealed during that due diligence process. And there's also that confidentiality risk, because you are sharing information with potentially a competitor or another player in the market, and you're sharing commercially sensitive information there. And there's also, because the party is external and they don't know the business, obviously, as well as yourself, there will be extensive warranties required as part of the legal process. So we also look at internal succession options with business owners. So one of those is a management buyout. So that's where you're selling to the management team. What we tend to see with these types of transactions is the valuations are lower and they are paid out typically over a longer period of time. So we may see up to about 5 years. The reason for that is that management don't necessarily have access to the finance required to actually buy into the company, and therefore it's the profits that tend to be used to pay off the sellers. However, for this type of transaction, we do see a higher rate of completions, because the owners are more in the driving seat and in control of the process. There's less risk because the buyer is, obviously knows the company and has hopefully been over, a period of time leading up to the transaction, has those business skills that are required to run the business going forward without the owner being there. Warranties we see they're less extensive in this type of transaction, and there's obviously less confidentiality risk as well. So these can work really well for some business owners. The other option, and it's increasingly popular, as Patrick alluded to, within the construction sector, is selling to an employee ownership trust. So we've seen these relatively new form of business ownership that have been around for 10 years. And it's highly tax incentive for a business owner, in that you can achieve a tax-free sale on selling your company to this trust, which is set up for the beneficiaries of employees. I think they're popular in this sector because obviously, there's a high reliance on human capital, and actually attraction and retention of staff in the construction sector is key. There have been significant changes in the budget, which is really around tightening up the rules and reducing the opportunity for abuse of this, particularly in light of the fact that they are so tax advantageous. And just briefly, there's basically a requirement for the trustees to oversee and make sure that there isn't an overvaluation of the company, but also making sure that there is true, independence of the trustees as well. So those are the three main options that I'm going to consider today, but also we are considering transfers to children, which I'm going to loop back to Trevor on that. In light of the inheritance tax changes, what does that now mean for passing on businesses to the next generation?
Thanks, Paula. Yes, the changes in the budget, I think, do change the landscape for business owners. If you look at the rules before budget day, then for a business owner who wanted to pass the business on to their children, the tax system actually said, hold it till you die, because it's tax beneficial. If you transfer it on death under the rules, actually, as we sit here today, but have changed on the budget going forwards, is that on death, you can pass that business to your children with no inheritance tax charge at all. So no charge there. And also for capital gains tax purposes, if the business is worth £10 million at that point, then the children are treated as having acquired it for £10 million, but there's no capital gains tax to pay. So you've actually got no inheritance tax and a tax-free uplift in the purchase price for the children. So actually very beneficial. The new rules change the playing field quite substantially. Under the new rules for inheritance tax, as I mentioned earlier, on a £10 million business, you would be looking at £1.8 million in inheritance tax. Now, most businesses and owners would not have the cash around to be able to pay that inheritance tax bill. So that could mean having to break up or sell part of the business or sell assets in order to be able to pay the inheritance tax bill, which is obviously not something a business owner would want to do. So what does that mean? Well, the business owners can now take a slightly different approach and look at when is the best time to transfer the business rather than waiting until death. Now, there are lots of reasons why you might want to transfer a business earlier to your children. You could be transferring it to them when they're younger, so in their 30s or 40s rather than in their 50s or 60s, and they may be bringing new enthusiasm, new innovation and energy to developing and growing the business. But as I said, historically, the tax rules have been against that. But if you look at what the rules mean now, if you transfer a business as a business owner to your children and you survive 7 years, then there is no inheritance tax charge to pay on that. And by transfer, I mean a gift. So it's a straight gift to the children, no inheritance tax charge to pay if you survive 7 years. So obviously you don't want to leave that too late in life where actually surviving 7 years could be a challenge. Now, as for capital gains tax, we don't get a tax-free uplift, and that gift to the children is deemed to be a taxable sale. But you can sign an election with your children whereby there is no capital gains tax to pay on that transfer or that gift to the children. So it can be transferred, gifted, tax-free to the children by doing it earlier rather than waiting until death. So there is definitely a change in the landscape whereby businesses are transferred during the owner's lifetime rather than waiting until death. Now, not all business owners are in the pleasant position to be able to afford to give away their business and have no income to live on. So what we are working with the corporate finance team is looking at cases where business owners sell part of the business or the whole of the business to their children. And that can be structured quite tax efficiently with some capital gains tax to pay over the payment period for the purchase of the business. Because obviously not every child can afford to buy the business. And so normally it's structured so that the business effectively pays the former owner over a period of time. And that might be 5 years or so, possibly 10 years. But either way, it can be looked as a way to transfer the business to the next generation and still provide an income and a tax efficient income to the exiting shareholders. So looking at the landscape for transfer to children, there are lots of opportunities around, but it does, in my mind, need a change in view about when you make transfers, and you want to do transfers sooner rather than later.
Thank you, Trevor. And actually, we've had a couple of recent cases whereby owners have had children in the business, but also other members of non-family management. So we've actually looked at hybrids, a little bit like you said there, Trevor, where we've looked at almost a management buyout where some members are family and some are non-family, because at the same time, it's all very well transferring the business to children, but we want to make sure it's in the best interest of the company and the wider management team and directors as well. So there are a range of options there. What I kind of do want to cover off, and again, it's something that we're busy working on across a whole range of sectors, but particularly the construction sector, is working with owners earlier to prepare what we call an options report. And what an options report is, it's a kind of a feasibility review that looks at a range of succession options that Paula and Trevor have alluded to today, but actually uses your business valuation to underpin, what an owner would likely receive in a trade sale, a management buyout, an employee ownership scenario, what the pros and cons of that are, but also with kind of Trevor and his tax colleagues look at on the current tax rules, what the net tax in your pocket would be at the same time. Again, aligning that with the risks and the advantages of each option. So that's a quite nice start of a 10 for clients who are thinking of succession. They're not quite sure which route is best for them, the shareholders, the management, and the employees, but it gives them food for thought to plan for kind of next steps, really. Moving on to questions. Now, we have had a couple of questions in early, which I'll start off with, and I think one or two have landed during the webinar. So the first question is I'll probably direct it to you, Paul, if that's okay. Do we have enough time to conclude a sale before the 5th of April 25? And I can only imagine they're talking about the changes to business asset disposal relief going up there.
Okay, good question. I think, if a business owner is in the middle of or wants to commence an internally, generated solution, so a management buyout or a sale to an EOT, then that is certainly feasible. And we've got, clients at the moment that we're just commencing that process with. If we're looking at a sale to a third party, so, if there's a buyer in situ, again, it is feasible, but it needs to be weighed up. And I think Trevor mentioned this earlier about value, because actually you might, by spending a little bit longer in those negotiations and really bottoming out the detail, you might be in a better position if the transaction does slip past the 5th of April. You still might receive more net proceeds in your hands by actually going through and having trust in the process. So yeah, it's a difficult question to answer.
Yeah, and you make a valid point, because I suppose in the sector, if you've got clients who've got planning applications or frameworks that they're going to be signed up to, and they may come into force next year or after April, it puts us in a strong position to go to market, doesn't it? And again, going back to Trevor's earlier point, it may drive the value upwards rather than trying to rush a sale through and also having a poor negotiating position, I suppose, acting for seller. So a really good question. The next question, I think one for you, Trevor. How will the changes in employers' national insurance affect construction businesses?
Oh, thanks for that one, Patrick. So how will it affect businesses? Well, all businesses, including the construction industry, their employment costs will go up. Anybody that's employed, their national insurance cost for anyone is going to go up by at least £615 per employee. And for an employee on average salary, which is 36,000, according to Google anyway, then you're looking at around about £1,000 increase. And for people earning more than that level, it'll cost employers more than £1,000 per year for that employee. So quite significant costs. However, I'm conscious in the construction industry, we've got people, there are people around on national minimum wage, etc. And the increases, which have been quite bold this year from the government on national minimum wage, together with the increases in employers' national insurance, especially the point at which the reduction at the point at which employers' national insurance starts being paid, means that for somebody on national minimum wage, you're looking about an 11% increase in payroll costs for that individual. And for somebody on national minimum wage under the age of 21, you're actually looking at a 22% increase in payroll costs. So there are significant costs across the board for businesses, and they will have to evaluate how they're going to cover those costs. That might mean that there are smaller pay rises, if any pay rises this year. It could mean that they decide not to take so many people on in the future, or it all has to go through increased costs to their customers. And ultimately, I think for most businesses, they won't be able to pass all the costs on. So it'll be some hybrid between all three.
Yeah, and I suppose in terms of business valuations and maintaining, let's say, it's a construction business that makes £1 million a year profit, going forward, if they've got 100 employees, it's now going to be 900,000, assuming they're on average wage. So what we need to make sure as well when preparing valuations is that cost, if we're selling to a third party, we can defend the fact that the business will still make £1 million. So be it mitigating increases in pay rises, as you said, Trevor, and passing on costs to customers, which will probably end up driving inflation up indirectly. But what we're working with clients at the moment on valuation exercises is understanding how that will impact future profitability and underpin the valuation on that. So again, it's probably got wider connotations than just going up overnight, really, Trevor, as you alluded to. So no, thank you. one more question that's popped up today. It's a technical one, so I'll open it to the floor. Is kind of what are the detailed changes around employee ownership trusts following the October budget? So don't all shout at once.
So I mentioned a couple earlier around independence of the trustees. So, you know, particularly mindful that sellers can't then control the trustees with themselves being represented and connected individuals. So that's quite a key change. There's also, and this is stepping on your toes, Trevor, it's around, there's no requirement now for tax clearance, which, so I guess in light of that, it's thinking what actually is required, because obviously the rules have tightened up.
Yeah, they're welcome changes, aren't they, Trevor?
They are, yeah.
I think they are welcome changes. I think that the comment on clearances, I think, is not a welcome change, but because I think our business owners on selling wanted that certainty that they were going to be a qualifying entity, and now that they will have to, on their tax return, effectively provide all that sort of information that was in the clearance to say, yes, this is why I think I qualify for my 0% tax. However, I think the changes are welcome overall, because a lot of employee ownership trusts have been abused. A lot of the transactions have been a little fake, let me put it that way. It's a bit strong maybe, but they have been abused, and HMRC have decided to tighten up the rules so that employee ownership trusts do actually meet what they are required to do, i.e. they are owned by the employees for the benefit of the employees and effectively controlled by the employees. And one of the changes that's come in is the qualifying requirements, rather than having to be met for 2 years, now have to be met for 5 years going forward. So that does put a lot of emphasis on the trustees to make sure that the employee ownership trust and the business are being operated for the benefit of the employees and not the former owners.
And the final point really on that is around, I think, the overvaluation, which I mentioned earlier. So it does mean actually this needs to be more affordable, and I think we wholly support that, and that, you know, it's for the genuine benefit of employees. And once you know, the former sellers are fully paid out, then employees should be rewarded for their contribution in the right way.
Perfect. No, thank you both. I think there's a poll question. So hopefully, if technology works, it pops on screen. So really, if anyone on the call here doesn't mind kind of answering the poll, and again, if anyone would benefit from talking to Paul or Trevor and or I after this, we'd be delighted to speak to anyone on kind of a consultation as they deem fit, really. While that's whirring around, I do want to kind of summarize by saying, and I think it's echoed between Paula, Trevor and I, you know, no longer can a business sell or an owner pass away holding the shares. It's no longer tax efficient. So now more than ever, it's probably key to plan early, be it a sale to the employees, a management buyout, a trade sale, or even offering share options today, and thinking about, you know, planning for tomorrow. But planning early ahead of any pending tax changes is key, really. I think I'll give that another couple of seconds. A few people have answered the poll. So in summary, I'd like to thank everyone for joining. There'll be a follow-up after this to all those who have attended, and wishing you an enjoyable day. Thank you.